Hey, welcome back. Hayden Crabtree here, and today we're going to be talking about if the stock market is going to crash in 2021, what I think about that, what I see, and how that should relate over into some things I want you to think about whenever you're going out and making your next investment. So if you're thinking about being an investor, if you want to get into investing, and you haven't yet, you may be thinking to yourself, well, man, I'm really scared right now because I heard the stock market may crash. I heard it may not crash. Should I invest in stocks? Will they keep going up? Should I buy real estate? What is the state of the market? So this video is going to be dedicated to making sure you understand a couple key points about where we're at in the US economy, how that relates over into the stock market, and how it also relates over into the real estate market and how you can plan your investment strategies around these different items. So today, all we're going to be talking about is facts, stats. We're not going to be talking about anything that's my opinion. These are going to be numbers pulled straight off of either government data websites or Yahoo Finance for actual stock information. So with that being said, let's dive into it. Before we do, if you guys would hit that like button, I would super appreciate it. If you're not subscribed to the channel, subscribe to the channel to get more financial news and real estate investing education every single week. Hit it and let's dive in. All right, so if you guys know me, you know I'm a real estate investor. I'm the author of this book, Skip the Flip. And in chapter number 7, if you hadn't gotten the book, you can get the whole book absolutely free in PDF or audiobook, link in the description here. But in this book, I talk about briefly real estate versus stocks and why I prefer real estate. And so one of the biggest reasons that I prefer real estate is control. And I talk about this, I think it's in chapter 7 of this book, is that I want to be able to control my investments. I want to be able to control my assets. I want to be able to control the future of what that looks like. And today, we're going to be going over some lifetime details of why I can't control the stock market. I can look at it, I can analyze it, but I can never control it. I can control my reaction to it, I can control my strategy around it, but I can't control what actually happens in the stock market, which I'm not a huge fan of. So we sit here, we're recording this at the beginning of April of 2021, and right now the stock market is pretty much at an all-time high, right? The S&P 500 is at an all-time high, the Dow's at an all-time high. And so what that means is that, the value of the companies that make up those indexes has essentially never been higher, right? If the index itself is at an all-time high, what that means is that the companies within it have never been more valuable. Okay, but on the same token, and we'll put this chart up on the screen here, is that there have never been more unemployed claims than there are being claimed right now. So we're going to put this up on the screen here. I'm going to walk you through what it means real quick. If we look on the left side of this chart here on your screen, we're looking back to whenever coronavirus hit. And so this dark line here, this dark line is the moving average essentially of how many people each and every single week have filed for unemployment benefits with the government, okay? I'll say that again. This dark line is how many people each and every single week, not an aggregate, each and every single week have filed for unemployment benefits from the government, meaning they've lost their job and they need help from the government. So if we start on the left, we can see these numbers are measured in millions. So as we see the A, that's April of last year, 2020, is about whenever, no, that might be March. I'm sorry, that's March of last year. March 28th is when this starts, 2020. You can see it at the top. And we can see that the number starts at about 2.3, 2.4 million people in that one single week filed for unemployment benefits. And as we move over, obviously coronavirus hit, a lot of people were getting laid off. And the moving averages just climbs and climbs and climbs. So we go all the way from about 2.3 million people a week, and you can see the tick marks on the bottom here that represent each and every single week. We move up to over 5 million people in one single week filed for unemployment benefits from the government. And then we can see it starts to go back down, which is normal as economy started to reopen, we started to figure out the state of the virus. And then when it starts to go back down and essentially reaches a we'll call it a flat line trough there at the bottom. So we reach right around 1 million people a week starting in, let's call it August, late August, September, have been filing for unemployment. So about 1 million people a week, even after the pandemic, even after we got our hands around the problem, are still filing for unemployment. That could be caused by a lot of different reasons. It could be people, are shut down. They try to stay open. Businesses try to stay open. They lost that battle, and had to close their business and fire all their employees, and therefore people are coming into the economy saying they're unemployed. Or it could be technological shifts. It could be jobs that are never coming back because people have figured out how to do things better, more efficient without humans in contact, than they were doing in COVID. So the point here about this is that if you look and if you're to compare the stock market chart to the unemployment chart, it's essentially inverse, right? Is that whenever the jobless claims are going up, the stock market's going down, or at least that's how it should be. And the reason that should be is because whenever stocks are valued, it's essentially how much revenue they're collecting. There's two ways they're valued. It's either by how much revenue they collect, and they multiply it out on a multiple, just like we do in real estate with a cap rate, okay? Or it's based off of the growth potential that company has, right? Value stocks or growth stocks. And so if we go and we look at the stock market, what we're gonna find is that whenever the initial jobless claims hit, the stock market tanked, and then it started to climb back as we got some government stimulus injected into the system, some helicopter money. But the interesting thing is that the amount of people that have continued to be laid off every single week as our stock market has started to climb is really insane. If you think about this, almost 1 million people a week have continued to file for unemployment, even into 3 months in of 2021, right? Almost a year after it's happened, almost economies are open. It's really, really crazy. So this is the first thing I want you to think about whenever we look at the all-time high prices of stock markets is what are the fundamentals of the stock market, okay? And so the problem that I see as a fundamental investor, as a real estate investor who seeks, below market value opportunities that cash flow, that give tax benefits, is that there's no fundamentals supporting the stock market that we're in right now. If there were fundamentals, we would have a healthy economy where, jobless claims would be lower and lower and lower, right? Until we didn't have those jobless claims, until we actually had jobs being created, more jobs being created than the jobs that we're losing. So this is the first thing, because if your citizens don't have jobs, they can't spend money, and therefore businesses can't earn a profit if they don't make any money, right? So just want you to think about this aspect as we look at the stock market. The next piece that I want you guys to look at is what are interest rates at the moment, okay? So high interest rates are indicative of a strong economy, okay? So a strong economy, meaning, businesses are thriving, everybody's making a lot of money, everybody has money. Interest rates can be a little bit higher because there's supposed to be a scarce pool of capital, okay? Money is supposed to be scarce. If money was abundant, in the way that everybody could have money, then there'd be no need for interest rates. People would just have money and they don't need to borrow money from other people. But money is supposed to be scarce. Money is not supposed to be abundant. It's not supposed to be everywhere. So here's why this matters, is that whenever everything is good and money is scarce, people will pay a higher interest rate, a higher cost of money in order to get that capital, because they can reinvest that money. Let's say, say they're going to pay 7% on that money. Well, if they can go invest that money and earn 10%, they would do that because that would be a net positive investment. So whenever there's not a lot of opportunities in the market, whenever there's not a lot of opportunities out there for growth, at a mass scale, then lenders have to lower their interest rate to say from 7% to 5%, because if there's no opportunities at 10%, but there are opportunities at 7%, well, I'm not going to borrow at 7 to make 7 because I'm not going to make anything, right? Because all of my profit, all of my 7% return on that project goes straight back to the lender. So the lenders have to drop their rates in order to get people to borrow money. So essentially where I'm coming from here is that if we go back and we look at this chart, we're going to put another chart on the board here. So if we look at this chart, this is a chart of the Treasury 30-year note, which is a government bond. And so this right here, this chart, if we look at it, we can see, this is a 5-year chart all the way back to about July of 17. We can see the interest rates are slowly climbing up, going down, climbing up, going down, climbing up into a peak of, about 3.3%, which was in, late 2018, Q4 of 2018. And then we noticed something really interesting. This time the government, there's no sign of coronavirus. There's no reason to really be dropping interest rates. We're supposedly at the strongest point of our economy ever at this point in late 2018 going into 2019. But as we look at this chart, something really interesting happened. What was interesting that happened is that rates started to go down even though we had a strong economy, full of opportunities. And they continued to go down from about 3.4, 3.5% all the way down to the beginning of 2020 whenever we hit about 2.24%, which is really interesting. Why would things be going down if we have such a strong economy, right? And then we noticed just a huge drop off right here at the beginning of 2020, and that's whenever the Fed and the government cut rates just immediately. They called it an emergency rate cut, where they cut rates all the way down to essentially the lowest point they've ever been of about 1.2%. And so things have gotten, here's cheap money. Inject money in the system, make it really easy to borrow money. Here's cheap money, here's cheap money. And so that's a sign of a weak economy, right? Whenever we have extremely cheap money. And so whenever we come back around to this is that we look at the chart and things start to go back up of a low to, again, about 1.2% in, call it July of 2020, and rates start to climb back up here. Now, here's the interesting thing, is that the government issues these bonds out. These bonds have a certain coupon that they pay. That's essentially like an interest payment. So if let's say you invest $1,000 on a 3%, that means annually you're going to be paid a 3% coupon on that, so you'd be getting $30 a year. Well, these bonds can be traded in the market just like stocks. So if I buy something that let's say has a, let's say it has a coupon rate of 3%, and so if I buy that stock for $1,000 and I get 3%, and that's what the market rate is at the time, well, if rates in the market go down to 1.5%, half of 3, the value of my bond doubles. The value of my bond, which is paying me a flat $30 a year, okay, that bond value goes to $2,000 because if rates in the market are 1.5%, we can take the $30 coupon payment divided by 1.5%, just like a cap rate, and we're going to get a bond value of $2,000. Well, if we go back and we look at the chart here, what we can see is that as the bond rates have increased from, call it July of 2020 to where we sit today in April of 2021, rates have only continued to increase here, but we don't have a stronger economy because jobs are what? Jobs are not abundant. People are filing for unemployment. We still need cheap money. Businesses are going out of business. And so what I think the cause of this is I think the cause of this is investors losing faith in the dollar. And what I mean by that is we've printed so much money since COVID happened, is that investors are essentially saying something's got to give here. This money we're just printing coming out of thin air, there's no sign that we'll stop printing it because jobs have continued to just evaporate into nowhere. People are continuing to file for unemployment. We need money to give to these people who are filing for unemployment benefits, plus all the stimulus checks. We're printing money. And I think that this upward rise of the bond rates, the interest rates, is essentially people saying, hey, I don't want to lock my money away for 30 years with the government because I'm not sure what the value of that is going to be in 30 years because we're printing so much money. I think that inflation is going to eat away at the value of the bond that I've bought. It may be paying $30 a year, but if that $30 a year, doesn't buy me anything and the value of my, my bond erodes, then why would I buy into this? I don't think that's a good play at all. So I think that bond rates and interest rates will have to continue going up, right, in order to make it appealing for people to want all these bonds. The government sells bonds as a way to raise money to give back to its citizens and take on different kinds of projects. So anyways, the whole point here is that I don't really see an end in sight for these increase in interest rates, which makes it harder for people who are starting new businesses or having businesses that are struggling that need to take on debt in order to continue operating. It makes it really, really hard for them to do so, and it makes it really hard for them to continue business. And I just don't see the breaking point of where we break back into a strong economy, if that makes sense. And so for that reason, I think that jobs will continue to not be rebuilt at a super fast rate. And I think the stock market could crash, but here's the caveat to all of this, is that the stock market works in cycles. All market works in cycles. We're at an all-time high, which means that an all-time low has to come at some point. But I think the administration we're in right now, the government that we're in right now, they'll continue printing money until, something really, really bad happens. And what that means for me is that they're going to print money as a short-term solution whenever the long-term solution would be to not print money. The long-term solution would be to let the pain happen, let things go back to where they're supposed to be, and rebuild from there. But if we print a bunch of money to keep it propped up at these super high rates, well then that's good for now because we don't feel the pain now, but long term it's going to be even worse as the US dollar becomes less valuable, less valuable, less valuable, and less valuable. And so if you have a stock market that's at an all-time high measured in dollars, let's say the Dow right now is at 33,000, an all-time high of 33,000, and let's say it goes to 50,000, which would be almost doubling its all-time high. Well, that sounds great. That sounds like we've got a strong stock market, and a lot of people think that means a strong economy, but what happens if the value of the dollar is cut in half? And meaning for every gallon of gas you have to buy, you now have to spend twice as much money to get that same thing. What if for every gallon of milk that you want to buy, it's now twice as much money? Is that really a good thing that everything costs twice as much, including, the stock market? If the stock market doubles in value, is it really a change at all if everything that you have to buy goes up in a factor of 2? If everything you're going to buy for $1 now costs $2, it's not really a good thing, right? Because everything is the same. So it may look good on paper, and that's what the government will do. The government will print money to prop up the stock market, keep it going higher and higher and higher. But essentially they're eroding all the money that you currently have in paper dollars. Because if I had $100,000 and I could go out and today in April of 2021, whatever I could buy with $100,000, let's say next year that same stuff that I was going to go buy cost me $200,000, that's not really good for me if I'm just sitting on $100,000. Now, where all this is good for you as a real estate investor, if you guys are real estate investors, this is why I am. If things start to go up, which I think that they will, if things start to go up in price because of inflation, guess what else is going to go up? The value of real assets and the amount of money that I could charge people in rent. And what's not going to change, like I talked about in Skip the Flip, again, if you want a free copy of this, super important lessons for the world that we live in today. If one thing that's not going to change is the debt payments that I have right now, right? So as a real estate investor, all of this is, I hate to say good news for us, but we're set up to take advantage of this because right now we can go borrow money from banks at cheapest rates in history. We can go buy assets that are going to go up in value whenever inflation does hit. And inflation is hitting right now, but whenever inflation continues to hit and continues to compound, we're going to benefit from all that. Our debt payments aren't going to change. Our cash flow is going to go up. Our equity is going to go up. And now we have to think, hey, how much is that equity going up really worth to us if everything else does cost money? But at least we're not on the flip side, because if inflation does hit, eventually the stock market is going to have to go in a negative cycle. It can't go up forever, right? I mean, it can, but it's pretty much impossible for it to continue to go up forever. It's been going up, historically for the last 11 years now. Being a real estate investor is a really good position to be in. I highly suggest if you're in the stock market only right now, you guys at least look into getting into the real estate market, diversifying your portfolio. And if you're all in on real estate right now, I applaud you. I am the same exact way. And so what this means is we're not going to sit on the sidelines waiting for any type of markets to crash. What this means is we're going to get out there. We're going to start looking for opportunities that are below what they're currently worth and that meet our business plan, our investing plan of finding assets that cash flow, go up in value, give us tax benefits, and that we can borrow on. It's called the ideal investment. It has income, it has depreciation, has equity build, it has appreciation, meaning it goes up in value, and you can lever it, the ideal investment. So I hope this video was helpful for you guys. These are my thoughts on the stock market. I am not a stock market pro. There are strategies out there to make money when it goes down. There are strategies when it goes up. There are strategies to make money when it stays the exact same. But here's the thing, each of those require you being right on what happens in the market and timing things up perfectly, which I hate. I hate having to time things up perfectly. If you have any questions about any of this, I hope it was helpful. I hope it was informative, and I hope you guys learn to do your own research and interpret the numbers for yourself. Do me a favor, subscribe to the channel, check out some of my other videos. I'd love to have you guys here every single week as we talk about more real estate investing content. Check out some other videos, and I'll see you in the next one. See ya.